Hi, hello, hi guys. All right, welcome back. All right, it's really nice to see you again for another week video. All right, thank you very much for coming back week after week actually to learn more about investing on your this journey. I really appreciate and thank you. I can be part of your learning process. All right, to help you to understand how to actually invest in the stock market using very simple methods that you learn actually from all this video series. All right. Okay, so in this week video, I'm going to share more about how another method that actually can use using the put option. All right, so remember last week I did share with you one option strategy, how actually you can use it. All right, by selling a put to actually reduce your entry price, as well as how to create monthly cash flow. All right, in this week video, we're going to go a bit slightly more advanced, riding on that same similar kind of put option. All right, in a way of a hybrid method that actually help you to actually as another strategy that you can actually utilize it, right, to invest in the stock market. Alright, without further ado, let's get started. Alright, a quick one as usual. Alright, if you're brand new to this channel, watch some of our video but yet haven't subscribed to our channel and you really like what we do, alright, please subscribe to the channel by clicking on the subscribe button on this channel itself. But of course, not forgetting by clicking the notification bell beside it so that you will be notified every single time when we actually upload a new video on this channel. Alright, so quick disclaimer, like a quick one. Whatever we share on this video purely for educational purposes, so please do your own due diligence right before you actually execute any trade, and do not take what I will share as a form of recommendation. Alright, okay, so in this week video I'm going to share with you how to actually use this new strategy called the bull push spread strategy. Okay, and the reason why we are using this strategy is this. Okay, so you just because mainly you found a very good investing opportunity on a big counter in a way that is very expensive, alright, but your portfolio is not big enough for you to actually do a protective put. Alright, that actually was covered in the previous video. Alright, okay, but you still want to actually not miss this opportunity. You really need to take some risk, make some money out of this opportunity at the end of the day. Alright, so this could be one of the shit you want to consider. Alright, so actually how does this bull push spread strategy works? Right, likewise, firstly, you need to find a good company with strong fundamental because it's going to go up trend on a long-term basis. Okay, so you need to find next is a good area of entry. So there's two ways about it. Either you find what is the intrinsic value of the companies and you start applying this strategy at or below the intrinsic value, or if you're more into the technical person, you just find where is the support level and then you execute the trade, or rather this strategy, when it's at that individual support level. Okay, so what you need to do is actually you just need to sell one put and buy one put at the same time at the selected strike prices. Okay, so let me give you an example. So basically this strategy is more in the community actually what we term it as a pocket money strategy. Right, so you doesn't want to put too much money into it, but because the opportunity is there, right, you want to actually invest a very small bit of your money into it so that you actually can take some form of pocket money out of it, right, without missing that good opportunity. Alright, so let me give you an example. Using the same thing as Coca-Cola, let's say the current share price 33 in January. The price is generally moving uptrend. You look at the technical analysis and you found out that actually price tend to bounce off the support level. So every time when you reach a support level, you want to do this strategy. But remember, because the portfolio is not that big, you are unable to actually do a full protective put strategy. You want to use this strategy to help you. Okay, so first thing, you identify that you want to actually sell a put contract. Okay, which very similar like the protective strategy. You sell a put contract. So in this case, for example, you're going to sell at a strike price of 32 and it expires the next month in February. So at the same time, we're going to buy a put contract, right, that expire one strike down. Alright, one strike down. So in this case, we're going to buy at a put contract that have a strike price at 31, which is also expiring on the same month, which is actually next month in February in this case. Right? So because you buy something, or rather because you sell a contract and you buy a contract, eventually you want to actually net actually have a credit premium collector. You want to collect some form of money. Okay, so I'm just going to give you a simple example. Let's say we're going to collect a 25-cent premium. Okay, so of course the price have a few different scenarios. Let's work this out, right? So let me just run through this with you so you have an idea how this actually strategy works. So for example, let's say after you initiate the two two options, you sell a put and you buy a put, and the share price from 33 went up to 35, what's going to happen? Right, so basically these two contracts and you have collected a 25-cent premium. Right, firstly, when the share price went up, what happened to your sell put? Right, basically your sell put will expire worthless. Remember, when you sell put, for you, you have the obligation to buy the shares if the price drop below 32. Right, but now the price maintained at 35, you have no obligation to buy it because it's not below 32. The contract will expire worthless. Right, how about the buy put? Buy put, actually you have the right to sell, right, when the price is below 31. But now the price is 35, definitely you will not exercise this contract because you can sell higher in the market, so the contract becomes expire worthless. And at the end of the day, you just keep this premium, you actually pocket 25 cents. Follow so far? Alright, let's move on to the next scenario. What if the price stays flat at 32? Alright, okay, you have actually this sell put, have the obligation to buy the share if the price drop below 32, because it stays at 32, your premium is going to stay the same, or rather your option is going to expire worthless because it's not below 32. Likewise for your buy put, okay, you have the right to sell when the price actually go below 31, but now the share price is at 32, so this buy put contract will expire worthless as well. So you collected to keep your premium, which is at 25 cents. Right, so just a quick one, the share price went up above 32. Alright, you just keep the premium because both contracts expire worthless. When actually the share price stays the same, alright, you will also keep the premium at 25 cents because the two options will actually expire worthless. Right, so the next scenario, what if the share price dropped to 31? Alright, so what happened to your sell put? Alright, your sell put firstly will be exercised because you have the obligation to buy if the price below 31. So definitely you have the buyer will exercise it, you have the obligation to fulfill the contract, you will have to buy the contract at $32. Alright, so now, okay, the price has dropped to 31, you have the right to sell if the price is below 31. So the share price now at 31, you can exercise your put option, alright, to actually sell off your share at 31. Okay, so what's going to happen is, you have bought at 32, you can sell at 31, you will have lost $1. But earlier you actually collected a premium of 25 cents, so net you will actually lost 75 cents in total. Alright, so remember, if the share price go below your strike price, you will start losing money. Alright, but because you have a buy put mechanism there, it actually also acts as a form of protection. Alright, what do I mean? Let me give you another scenario. What if the share price actually dropped to $15 instead of 31? Alright, so let's run through this together. What's going to happen to your contract? Right, so when you sell a put at 32, when the price drops to 15, you have the obligation to buy the share at 32, right? Because that's the definition. Okay, so how about your buy put? Your buy put, you have the right to sell at the price at 31. Now the market is at 15, you have the right to sell at 31. Will you want to sell at 15 or 31? Definitely you want to sell at 31 instead of 15. Alright, okay, so what's going to happen net is, you have bought at 32, you have sell at 31. Alright, you will have lost $1 because at the start you have collected a premium of 25 cents, so net you have actually net loss of 75 cents. Right, do you notice something? Alright, so if the share price has dropped so much, actually your P&L is exactly the same as if the share price had just dropped a bit by below at 31 or slightly below. Alright, so this mechanism, or rather the buy put mechanism, help to protect, alright, your losses, alright, as if the actually share price has a huge plunge. Right, so this actually allows you to make some money from the stock market, particularly on a big stock, because some of us, we doesn't have a very big portfolio, but you just want to make a small gain out of it by using a spread itself. So we're going to profit from the difference by collecting the premium, and that is, but we're going to protect our losses by keeping our option change within that spread. Right, that will actually help you to limit your losses. Okay, right, so actually how much capital do we need? Right, that's the most important thing you know to work out. Firstly, how does you do this strategy is actually the capital you need actually is the difference between the two strike price multiplied by the contract that you are doing multiplied by 100 shares. Alright, so for example, if your share price is $1 different, in this case we use 32 and 31. Alright, the capital you need, assuming if you're doing one contract, you will need $100 capital. Okay, what if your strike price is different? It's a difference of $5. So for example, you did a strike price of 35 and a strike price of 31, that's a $5 difference. Likewise, you do one single contract at 100 shares, that means you will need $500 capital for you to initiate this bull push spread strategy. Right. Similarly, likewise, if the spread is $2, for example, you need 3 contracts out of 100 shares, right? Basically, you will actually need $300 capital. Okay. Right. So it's not very difficult. It's very simple. Let me just run through a quick summary with you what we have went through. Right. So basically, we are just running through. We are actually going to do this called bull push spread strategy. All right. So it actually helps you to actually identify good opportunity you want to invest, particularly on very big counter, very expensive stock, but yet because you have a very low portfolio and you still are able to actually profit from this opportunity by using these put options. Okay, so actually how you do is you just sell a put and buy a put where you actually identify a good area of entry. Right, so when the price went up or went sideways on the expiry date, basically you keep your premium, you make money. But when the share price actually went down and go below your strike prices, you actually have losses on the expiry. Okay, so always work out your capital. Just remember how much capital do you need. Basically, it's the difference between the 2 strike price multiplied by the contract they are doing, multiplied by 100 shares. So that's the amount of capital you need for this particular strategy, this position. Okay, so I hope this strategy is useful because it opens up a lot more opportunities for you if you want to test and make money for the big and expensive stocks in the market, especially when the capital is small. So I hope this strategy will help most of you who have smaller capital, and just use this strategy wisely and investing safely. Alright, okay, so I hope you like this video. There's going to be a couple more strategies upcoming in the next few video. Please look out on this channel and hopefully those strategies will help you as well. Okay, if you are still unclear about this strategy or the previous strategy, please review these videos again. If you need some help, please comment below and I will try to answer them, answer your question, query and clarify your doubts on it. Alright, okay, so once again, thank you very much for watching and I'll see you in the next video. Goodbye.